Welcome back to the What's More podcast. I'm your host, Quinton Harris. I've been battling a lot of people online recently, especially in the YouTube camp, about this $17 trillion of equity that I talked about is available in the housing market in the United States. And anywhere you look, people are going to tell you about this crash that's coming, the bubble. 2008 seems to be the buzz year. And this episode's for you because, what I'm trying to do today is not so much debunk that. That's not what I'm trying to do today. I'm trying to understand where these people are coming from, but I'm also going to present facts that don't show up online. And what I mean by this is it's real easy for someone to say, oh, man, this is going to crash and here's why. But where's the data? I'm not saying an opinion is not important, okay? But where's the data? Today, I want to talk about that. So in today's housing market, we're presented with all kinds of challenges. Affordability being the main one due to interest rates and inventory, and that inventory and interest rates are leading to higher home prices. That's one of our bigger challenges. But some people are really quick to panic over this, and they're super quick to say the housing market looks stressed. And I'm not so sure that's the answer. And they're fearing and that we'll see another 2008 crash and that these levels of destruction are going to happen in the equity side of things. Yet, I believe there's a significant divide in this theology. And here's why, and here's what I think the divide is. I think the divide is simple. Either you own a home or you don't. And what I mean by that is this. If you're a homeowner, you're not one of those people preaching the 2008 doom is coming. If you don't own a home, you're probably subscribing to that. And, it's interesting to me as I kind of traveled down this path coming up with this podcast and kind of jotting down some of my notes. I did a simple survey. And I was at a restaurant, and I had a waitress that was, I could venture to say I didn't ask her, but I think she was in her mid-20s. That's the vibe that myself and the people with me got. And we had gotten into this debate at lunch, and we were discussing this housing market. And some of the people there with me were like, why do they think it's going to crash when people are saying this online? I said, I just don't know, but let's just do a simple test here. So we asked the waitress. We said, hey, listen, question for you. We're having this debate. This is what we do for a living as far as this is our jobs, and we're in real estate, and we're in banking. We're talking about this. So I wanted to ask you a question. Do you think the housing market's going to crash? And her response was priceless. It was, well, it has to, right? And I kind of thought to myself, there it is. That's it. So and I said, ma'am, do you mind if I ask you a follow-up question? She said, sure. She was super nice, by the way, and she was very honest, and I appreciate her participating in this experiment. I said, do you own a home? And she kind of smiled, and she said, no. And she goes, is this more of a psychological question, or is this more of are you trying to settle a debate? And I said, no, that's a great point as well. And she goes, I said, well, let me ask you this. What do you think people that own a home are saying? And she said, yeah, I don't think they're probably sitting around saying it's got to crash. And I go, I really appreciate you participating in this, giving us honest feedback, and she was awesome. Obviously, we gave her a great tip. But the reality to this is that it kind of was real quick, unprompted, proved my point. And that was the people at the table with me were like, dang, no one even prompted her for that response. And that's exactly what we got. And so here's what I say, you see these people that don't own a home that want to see, hey, listen, I need a home price to crash because that's the only way I'm going to be able to afford the home that I want. That's part of this theology that we're seeing online. And when people are kind of commenting on us, that's what they're putting in there, right? This crash is crash. So I'm going to break in today and kick off this podcast with a simple question. And I'm going to ask it probably a couple times, but what's going to come first? The lowering of housing mortgage interest rates, or is there going to be a housing crisis? Are we going to get lower rates for more affordability, right? Or are we going to have a housing crisis? We'll see. So if you've been listening to our podcast, you know a couple things about us, and you know exactly where I stand on this. But I've recently been spending a significant amount of time trying to understand this other side. And here's what I have found out in this market crash theology and what I see is happening here. A lot of opinions versus facts. And more importantly, I found myself kind of challenging those individuals and presenting this data, the data in which I'm going to talk to you about and show you on this podcast. And if you're not subscribed to our YouTube channel, please go ahead and subscribe at What's Your One More with number one, because a lot of the data that I'm going to run through here, my producer Charlie is going to put on the screen here, and we're also going to have it in the show notes down there. And I think it's extremely valuable because it's real data that we were able to analyze. We're going to have some wonderful graphs. We got some great partners that we were able to kind of partner with to get this information on there. And shout out to Housing Wire on there for what they've done, and we'll get that information on here as well. But let's take a look at this here. So when I challenge people with some of this information, my favorite response, matter of fact, it's the same response over and over again. It's crickets. Like, I don't get a single response. And I think the reason why people can't counter what we're showing them is because we're delivering facts against those opinions that are fear-mongering. And so let's go ahead and get started with this because I think this is interesting. So let me start with a few things here. So we're going to start with new listings. Now, new listings, just for people that are not aware of that or not part of our audience, new listings measures the amount of new inventory, new listings that have come on the market for sale, and we get that every single week. So when you see a headline that says, hey, new listings are up, okay, that's for that week in particular, measured from the week before. So as I kind of always talked about on the show, if I go from a 2 to a 3, did I go up? Yeah, that's an increase. But it's not 2 to 1,000, right? It's not a drastic increase. It's a minor increase. It's the slightest of increases, but that's not necessarily what's explained in the headline. And this is a great example to where we see a headline and we need to zoom out and get a little wider with our perspective. And the headline usually reads, inventory's up, new listings are up. So I took down the listings and kind of looked at them from 2009 all the way to 2022, because the doom and gloomers of 2008, hey, it's coming. This is just like 2008. All that's going to happen is that we're going to have more people sell their homes and more people put them online, but no one's going to buy them and the inventory is going to grow. Inventory's already up. That seems to be the response, one of the growing responses I get about inventory on here. So I was like, you know what? Let's just go ahead and take a look at this. So as a baseline, what is considered a healthy market? So let's start with that. A healthy market is 80,000 new inventory homes coming on the market every single week. And the reason it's 80,000 because we want to see 4.1 million in inventory, total, inventory active. And that's how you get there is 80,000 a week divided by 52 gets you 4.1. 4.1 would be like a healthy market, like baseline, right? 80,000 per week baseline. That doesn't mean it's like over so much inventory you can't handle it, and it's not enough to where you can't satisfy the demand. So last week, that number that came in was 70,606 new listings. That's not 80,000 by any means, right? And the reason the headline read inventory is up is because last year at this time, we were at 61,700 homes. So it's up. So inventory up, right? New listings are up. But if we go back to 2022, that inventory was 90,000, almost 91,000. So it's kind of a misleading type of dynamic. And here's the thing. Let me go back to this. I look at this as a healthy market. In 2015, it was 81,000. I keep looking at my notes here. Is 81,000. 2016, 80,000. 2017, 84,000. You want to know what 2009 was? For all the 2008 people, 2009 was 281,000. 281. 2010, 345,000. 2011, 400,000. Same week during that year, those were the numbers. That's not even a fifth. Like 70,000 is not even a fifth. It's not even a fifth of those numbers. So when you see that, there's no correlation between 70,000 and 396,000, right? There's no correlation. And mind you, 2011 was the peak of the bad, right? Because that's when we started coming out of the bad and kind of trending back in. But it was the worst of the worst because it was at the tail end of that, not good point in real estate. Not 2008. 2008 wasn't necessarily the bubble. The bubble kind of was really more on the tail end of that. But in essence of this argument or this debate, I just wanted to show those numbers from 2009, 10, and 11 because those are the really big numbers on there. And this is not like that time frame. And so I think that when you look at a seller's market versus a buyer's market, the data during that 2009 and 10 is that the problem was those were distressed sales. We aren't having distressed sales right now. I mean, there's not many the foreclosure numbers are already very low. Some might argue the lowest rate in the history of foreclosures in the United States. And the distressed sale that was taking place during that 2009 to 2012 era, those were short sales. And those short sales combined with foreclosures took a really long time to move the product. I mean, in today's world, the average days on market is less than 45 days. I mean, it's in some markets less than 30. During that time, it was almost 8 months because you had to process the short sale. You had to process the foreclosure. Foreclosure had legal, jurisdiction it had to go through. So the time frame was a lot longer, which caused the listings to go up and also caused the time on market to go up. It's a different time. Some perspective is, this week peaked our total inventory for the year, by the way, at, 645,000 new listings, right? Well, prospective in 2000 content, like 2015, this was 1.2. So we're still below like a healthy market just in that area alone. And, and I think the reason some people will say 2008 is because home prices have gotten so high, but they haven't really fallen off a trajectory that doesn't make sense. For example, if you drew a trend line at 4% over the last 40 years, we're still below that as a country. And in some submarkets, it's way below, some is a little bit above, but the overall averages, we're below it. So it's not like we're just, flushing this huge 20%, 30% year over year. There was significant gains during COVID and coming out of COVID, but there were significant losses between 2008, I guess really started in 2006 to 2012. Those losses were never, ever made up. And I guess you could almost argue those losses were put back on track during the pre-COVID era to where we are now. And I think if you're new to real estate, and what I mean by that is if you're a buyer now, you weren't a buyer in 2012, 13, 14, 15, so forth, so on. If you became a buyer post-COVID, well, all you've seen are these rampant gains, right? So if you're sitting here going, oh my God, like you can't continue with this because it's just been 20%, 25, 30%, like that, I agree with you on that. Like that, I don't disagree with you on. But because maybe you weren't a buyer in that 2012, 13, 14, you didn't see those significant losses during the greatest real estate depression that happened, right? And traditionally, we don't see those losses. That was a one-time thing. But we also don't see these 20, 30% gains. That appears to be a one-time thing. What we typically see is a 4 to 5% gain in real estate. If we're lucky, sometimes it's 7%. But the reality is, if you weren't around and you weren't a buyer during those super dips and those super peaks, you're kind of leaning towards one side. And so it makes sense to me why a lot of new buyers are saying it has to crash, right? That's because all you've seen are these gains. And so another argument that we talk about online, and I would say maybe it's not an argument, maybe it's a debate. I don't know, but I'll say this. One of it is the price cut discussion. Like, oh, we've already seen prices get lowered. We've already seen sellers selling their homes less than what they're listing at. Well, first of all, that's normal market, right? That is normal. And I would say it's normal to the tune of about a 3% differential from, if you look at like list to price sold, 97% is not abnormal, right? 10%, yeah, that's a problem, right? If it was 10%, I would say, oh, okay, that's an issue. But first of all, it's normal, right? That's called negotiation. That happens all the time. And when you don't have negotiation, it's usually not in the buyer's favor. But and that's what we saw during COVID, right? But right now, that's normal, and it was normal prior to COVID. But what I'll say about that is that cutting prices, as people say, I've seen a lot of videos like, oh man, they're cutting prices, they're dropping in value. Well, no, that's not what's happening. And I did a whole podcast on the lock-in effect and what it means for sellers and sellers that have these low rates, right? The mobility rate is so skewed. Mobility rate meaning that if you have a 2.5 or 3.5, 4.5, you get the point, and you've got to move and you're moving to a 7, that is not a mobility rate that is enticing. And in some cases, it's unaffordable. People have built their life and their budget around those lower rates. They're not enticed to make that move, so therefore they're not going to do it. And that is making inventory tighter. But for the people that are willing to make that move, the people that are willing to entertain that mobility rate, they're going to require a premium on their home. And in most cases, they don't have to move. So if they don't sell it, who cares? They got plenty of equity, right? But maybe they're willing to negotiate 3% differential, but these huge price slashes that I keep seeing people talk about online, I saw, I think there was a person that commented and said, oh yeah, and homes are $60,000 less than when they listed. Well, okay, that bodes the question this. A, did the seller say, listen, I'm just going to throw it out there and see what I get? And if it gets so high, that's great, but they're padding in a profit no matter what. Maybe 60,000 is plenty. And the other thing was, what was the price of the home? Like, was the home 600,000 or was the home 1.6 million? Like, what was it? Let's put this in perspective. I asked that question, I didn't get a response, but I'm willing to think the larger the price cut, the bigger the price of the home. You're not seeing $100,000 cut on a $600,000 home. That's not normal, right? And so those are one of the things I look at on there. But I did want to go through analyzing the last 3 years of these price cuts, right? Basically year over year I look at. And so we had 31% of the transactions had a price cut in 2022, 32% in 2023, and 38% in 2024. Yes, those numbers are going up, but that is nothing to be alarmed about. You're having 38% of the transactions not getting full list price. they're still selling, and they're not selling at these astronomical cuts when you have the average of a 97% list to price ratio. That's also perspective. Last part, I shouldn't say the last part, but another part of the argument that I see from the 2008 camp are pending sales are down. And, that I don't think that is necessarily the case. What I think the case is it's a lack of inventory. And if you don't have enough inventory, you're not going to have pending sales to offset that, right? So if you have 10,000, attractive inventory, right? They're priced right. They're going to move. You're going to have more pending sales. But if you have 10,000 homes that are priced way high because the seller's going, I don't need to sell, but if I'm going to sell, this is what I'm going to sell it for, you're going to have less pending sales because there'll be less offers being made or less contracts being produced because of that. That would make sense. It also appears where the market is right now. Another topic I want to talk about was I did a podcast on the $17 trillion of equity in the market. That stirred a lot of conversations on there. And what I would say is this, the thing that came back from that was the notion of false equity. That was one of the things I heard people talk about. Oh, that's all false. That's all made up. That's margined equity. A lot of big words, but not much data to go behind it. And so I'll tell you this theme of 06 to 11 that just keeps popping up. Keep in mind for the first thing, this was very, very, very unusual and never done before, but this became real life for a lot of people because Hollywood made that really life. Like I watch a lot of the people talk about this stuff online, and I've had comments, and I don't know if this is a compliment or a backhanded comment, but they've said, was this dude even alive during that time? And first of all, thanks for the compliment. Second of all, yes, I was working during that time. But the reality is this, a lot of the people that are saying this kind of stuff I watch online, I know for a fact they were not a home buyer during that time. I know for a fact they weren't even of age to buy a home. So a lot of the notion about what happened during that time is usually either coming from stuff they were told or Hollywood. The Big Short made a lot of people aware of what happened during that time, but a lot of that was Hollywood fluff too, a lot of it. The reality between 6 and 11 was brought on by really bad credit availability, being that anybody could get it, right? It was over available, but it was bad in the sense that the checks and balances weren't good and too many loans were given out at will. Appraisal pressure, borrower fraud, and greed. That is the reality there, right? And then that trickled down into poor equity positions. It trickled down into loans being upside down. And it trickled down to lack of buyers and more sellers. And it became a huge issue. That's a little different than where we are right now. I mean, you could just go Google credit availability, right? And you will see, if you type in Google credit availability from 2002 to 2024, you will see a drastic difference between the available credit borrowing than what it is today to what it was in, you really need to go back to 02 because that's where it really started. That you had 02 all the way to 06. It's drastic and it's not even close. Like some of the programs don't even exist that were available then. And so I think it's a much different stringent guideline, which means the people getting these loans are better credit qualified. And it doesn't mean they're getting them without proving their income and without proving their credit worthiness to make the payment of the loan. That's a significant difference. The other thing is this. I would say that when you're talking about foreclosures, I got a graph on here. And again, this is thanks to Housing Wire, the New York Fed. When we look at foreclosures, something I want to point out on this is that we had this massive credit bust in 2005. So I'm talking about the credit availability from 02, and then the credit bust started in 05. And you'll see it in this graph on our YouTube channel. Again, if you're driving and listening to this on our podcast, on Apple Podcasts or Spotify, take a chance to go over to the YouTube side and look at some of these graphs, because this is a real thing where like the numbers don't lie. It's pretty impressive on here. But what you'll see is you'll start to see in 2005 the credit bust starting. And what's interesting is how it leads up to 06. And then it continues all the way through 6 to 2008. And then what happened during that time was we started having a significant amount of job losses, and the recession started. It was actually deemed the recession during that time. So we had job losses, which also led to the foreclosures. The job losses led to the short sales, because a lot of people were able to claim the job loss, and the lack of being able to get a new one is why they need a short sale versus the foreclosure. And that was a big deal. They also were able to get loan modifications during that time. Well, that's another argument people are making online. Well, what happens when people lose jobs? I'm going to get to that one in just a minute here. But what you can see is in this chart, there's a black line that shows basically the years before the Great Recession, the credit bust that started to happen. And then you can see what's going on right now and why this is not the case, because new listings started to rise at such a high significant amount, as I talked about earlier in the podcast. And look at where it is right now. It's almost a flat line, right? It's a plateau, and they're not even close. So that's another reason why I don't think this this notion of new listings rising is going to lead to foreclosures and job losses. But the job loss thing is interesting because unlike 2008, when people started to lose their jobs, they didn't have an equity position in that home. So when people lost their jobs and they're upside down, whether they're upside down 20%, 10%, there wasn't enough in the transaction for them to sell the home and afford a real estate agent and afford some of the mandated closing costs that the seller may be responsible for. And they clearly were in trouble, so that whatever money they had to bring to the table, they needed to keep. So they would ask for the short sale or they would ask for the loan modification. And in some cases, it had to go to foreclosure. Well, the biggest difference now is there are trillions of dollars of equity. The average American has $180,000 in equity. When they have to sell their home, and I'm not saying when, but in this scenario, if someone loses their job, I'm trying to make the argument that the people are making online. Well, what happens when these people lose their jobs because the job market goes to trash? There will be equity in the home to offset the sale of that property, and there will be profit in that equity for the seller to have to better themselves on the other side of that sale. What I'm getting at is it won't be a forced sale or a short sale or a foreclosure. And, when you take a look at like the equity positions in America, and again, I'm going to put this graph on there as well because it's great research here. This is from, Altos Research showing that only 1.8% of mortgages, so that's less than 2% of mortgages, have a negative equity position in America right now. That includes everyone that's gotten loans in this 2024 environment, Q1 2024, all the way back. Less than 2%. So that is a drastic difference from where we were in 2008. Drastic. And over 1 million homes have 50% equity. You can even say they're just 50% loan to value right now. So massive equity positions in homes right now compared to what it was during that time. And I just don't see how a negative job market is going to lead to a foreclosure wave. Now, I also think a negative job market would be bad for the economy. And I think it's something that's been growing in the background. If you've listened to our podcast, we've talked about this. But the one thing I want to talk about here is I want to be able to counterbalance the argument of, hey, what's going to happen when people lose their jobs and everyone goes into foreclosure? Like, again, that's because you saw that in Hollywood or you were told that by someone. The people that are usually challenged that, they didn't live through it during that time. Now, don't get me wrong. I've got some friends that went through this nonsense with me, and nonsense being, 2006 all the way to 2012. And if you lived through that and you worked through that, we know we've got these financial scars on our arms that we look at every single day. Every time we make a financial decision, I guarantee if you live through it, you go back to, I just don't want to be in the position I was in 08, 09. I've said that to myself before. I know exactly what that was like. And so I get that. But I also say I have to look at this with clear eyes. This is not where we are right now. And the data is also supporting that notion. This isn't me just giving my opinion. And I'll say that, one of the most significant changes in the housing market right now has been the reduction in this underwater of homes right now, basically the underwater equity. It's just something we didn't have before. And I think that when you look at that now and you look at these charts again, go to our YouTube channel, watch your one more, you will see that. And so last thing I'll end on right here is that going back to the job loss recession, right? Going back to these job numbers that are coming in, while the most recent unemployment numbers came in at 4.1, they're higher than, I think that's higher than what the Federal Reserve projected for the end of the year, by the way. While it's coming in higher now than thought, it's still relatively low overall. And just like the rest of the data that we're seeing here, yes, there are some one-offs. Yes, there are pockets in which neighborhoods are different than others. The overall health of the housing market is much better than it was coming into 05, leading into 08, 09, and 12. And for me, I don't see an argument and I don't see any data that suggests that there's a housing crash, housing bubble coming. And I can't say that enough over and over again. And if you're listening to this podcast and you're someone that's being impacted by the fact that you think a housing crash is coming and that you have to wait, don't let that negativity feed into your desire to be a homeowner. Because right now may not be the time for you. But what we will see is in 2025 and in 2026, I can assure you the home prices today will be higher in 25 and in 26 than they are today. And I'm willing to bet that I'm much, much more on the right side of this argument than the people that are claiming the crash is coming, because the people that are claiming the crash is coming are not homeowners, and they're people that are looking to get a bargain deal, and they're not going to get it in this market, and they're not going to get it in future markets until the demand matches the inventory, and the inventory is not caught up. And that inventory is going to be supplied by new builds. And we've talked about why the new build market is suppressed and why we don't have enough to backfill the demand on here. So I hope this helps. If you like what you're hearing, please share this podcast. Please 5-star review it. If you don't like what you're hearing, right, I encourage you, come online. Tell me why we're wrong. Show us more data sets. I'm all about it. But I will tell you this, we will continue to share our information with you. We show you all of our data, where we're getting it from. We don't make anything up. We show all of our sources. A lot of these sources are paid for sources that we've been a part of for years. And that's why we share it with you guys on here. But again, it's all data driven. There's nothing on here that we're making up. So if you like what you're hearing, 5-star review this podcast, please leave us some comments. Check out our YouTube channel at What's Your One More. And guys, stay tuned to the next episode of What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I